If you've spent any time trying to learn how to trade, you know exactly what this feels like. You're sitting in the dark, staring at a dozen blinking screens, trying to decode a language you barely understand. Usually, the first trap you fall into is indicator overload. You get told to throw an RSI on your chart, then Bollinger Bands, then a MACD. By the end of it, your screen is a colorful mess of lagging data that tells you what the market did 10 minutes ago, not what it's doing right now. So you pivot. You spend thousands of hours diving into institutional market concepts, trying to track smart money and map out massive, complex order blocks like a Wall Street hedge fund. Retail trading is a zero-sum game, which means institutions need your predictable behavior to find their own profits. By piling on complex indicators, you're just providing a clearer map for algorithms to trade against you. When you try to fight that battle by relying on gut feelings or by consulting 5 different messy indicators that contradict each other, your account usually gets liquidated fast. Searching for a perfectly complex, all-knowing strategy is exactly what destroys most retail accounts before they even understand how the market moves. Instead of asking what the smartest or most complex strategy is, we need to evaluate systems based entirely on their return on investment. How much time are you putting in versus how often you actually succeed? This chart shows an effort versus impact matrix. We have the daily time required on the vertical axis and the realistic probability of retail success on the horizontal axis. When we plot complex indicator strategies, they land squarely up here in the top left. You spend hours analyzing dozens of data points for a very low win rate. But if we look at the mechanical session range strategy, it sits right here. It requires less than 90 minutes a day and relies on simple, proven price action to yield a high probability of success. The most effective tool for a retail trader is statistical, boring, highly mechanical repetition. Choosing a purely mechanical system forces you to make a trade-off. You have to give up the emotional adrenaline rush of gambling and accept the cold, boring reality of statistical probability. That brings us to the first candle range fakeout. It's a stupid, simple 3-step system. Step 1 is establishing your time anchor. You pick a specific trading session, say the 9:30 a.m. New York Open. Then you sit on your hands and wait for the very first candle of that session to completely close. This chart shows exactly what that looks like. We isolate that first 15-minute or 4-hour candle, and we draw strict horizontal lines at the exact highest and lowest points to box it in. By setting these boundaries, you completely eliminate the chaos of the opening bell. You can clearly see how the wild, early morning volatility stays mostly contained within this channel. The trade-off here is extreme patience. By forcing yourself to wait for that first candle to close, you are going to sit on the sidelines during some of the market's biggest early moves. Watching the market run while you have no position is incredibly difficult. FOMO will scream at you to jump in. The time anchor exists to restrict your actions, not to predict the market's direction. Step 2 is where we look for the trade. We wait for the price to break outside our established range and then fail. This chart shows the initial breakout. The price action pushes up and the candle closes entirely outside of our top boundary line. Wicks alone do not count. The vital mechanic happens next. We need the price to rapidly reverse, drop back down, and close firmly inside the original range. We use a fair value gap to separate significant momentum from random price fluctuations. This 3-candle pattern confirms that the reversal back into the range is supported by actual volume. Trading this specific sequence protects you from algorithmic stop hunts. Instead of getting chopped up, you are specifically profiting off the failure of everyone who bought that initial breakout. Demanding this strict sequence means you will completely miss the clean, beautiful breakouts that leave the range and keep running. You won't catch those. By intentionally sacrificing standard breakouts, you filter out the messy market noise and only risk your capital when the chart exposes a clear trap. Once the trap is confirmed, Step 3 removes all human emotion from the equation by using a rigid 2-to-1 limit order. This chart outlines the exact spatial setup. Your entry line sits right on the fair value gap. Your stop loss is placed precisely at the extreme tip of the recent fakeout candle. To set your target, you take the exact vertical distance between your entry and your stop loss, and you mathematically double it downwards. That is your take profit line. Because you are making twice as much on your winners as you lose on your losers, you only need a 34% win rate to break even over the long term. Setting a limit order lets you walk away from your desk. You completely remove the urge to micromanage the trade out of fear when the price starts chopping around. The downside to these rigid rules is that occasionally you will get stopped out by a single pip, and you will definitively cap your maximum upside when a trade goes on a massive all-day run. Accepting a hard mathematical cap on your potential profits is the mandatory tax required to achieve long-term, stress-free consistency. So the mechanics work, but in the real world, whether this strategy is actually profitable for you depends entirely on your personality. This scorecard breaks down who this system serves. It is ideal for a time-poor professional checking charts an hour a day, or an overwhelmed beginner stripping indicators. Conversely, avoid this if you are an adrenaline junkie or a home run hunter flipping small accounts. If you prefer reading live order flow or need constant action to feel productive, this system will bore you into taking bad trades. A strategy's theoretical win rate is secondary to how well the system aligns with your actual psychological profile and daily schedule. Looking closely at the return on investment for retail trading, the takeaway is pretty clear. Profitable trading is not about perfectly predicting the future of the market using complex tools. Long-term success comes strictly from executing a boring, repetitive edge with emotionless risk management. The mechanical range strategy is stupidly simple, but surviving the choppy, losing weeks that inevitably happen requires relentless, painful discipline. Ultimately, you have to choose your trade-off. Do the hard work of daily discipline, or face the hard reality of losing your account to complexity.